Okay, hi everyone. Thank you guys so much for waiting. There was some issues. The previous people mentioned that they couldn't see my slides, so I had to just restart everything. But yeah, I think we got it working now. So let me know in the chat if you guys can see my screen. And we're gonna give about 2 more minutes to let more people join the session before we get started. So in the meantime, let me know in the chat if you guys can see my screen and can see me clearly as well. And yeah, I'll see you guys in about 2 more minutes. Thanks, everyone. Okay, let's just go ahead and get started. So as per usual, before we get into it, just a disclaimer. So a risk warning, our products are traded on margin and carry a high level of risk, and it is possible to lose all your capital. These products may not be suitable for everyone, and you should ensure that you understand the risk involved. So, a disclaimer, the information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. This material is just the personal opinion of the author, and the client's investment objectives and risk tolerance have not been considered. IronFX is not responsible for any loss arising from any information contained herein, and redistribution of the material is strictly prohibited. So I'm Melanie. I'm an investment analyst from Everest Fortune Group, who are finalists for Best FX and Equity Research in the years 2019 to 2021. So here's our agenda for today. We're going to do a really quick recap on last week's, the first part of our ICT topic, and then we'll look at liquidity pool manipulation and then stop hunts. So where's appropriate for you to place your stop loss, and then we'll look at market structure. Okay, so what is ICT? So just a brief recap, the inner circle trading, or ICT, is now one of the most popular trading strategies around, focusing solely on price action. It also focuses on understanding the inner workings of the financial markets and was originally created by Michael Huddleston to trade the Forex market. But currently, traders are using the same strategies to make profit in all and any market that they trade. So, this involves analyzing market dynamics, identifying supply and demand zones, and utilizing price action analysis to make informed trading decisions. So here's the importance of understanding inner circle trading. So in today's highly volatile and competitive financial markets, having a deep understanding of how the markets operate can give us a significant edge as traders. So by mastering inner circle trading techniques, you can then leverage on those um, and enhance your ability to identify high probability trading opportunities and also effectively manage risk. Okay, so the ICT methodology employs chart technical analysis, which we will see in a little bit, operates under the premise that by studying price movements, support and resistance levels, order blocks, like we mentioned, we'll look at stop loss levels today. One can to some extent pinpoint the areas with the highest liquidity concentration and consequently forecast emerging trends. So there are some key concepts that we went through last week that I just want to briefly go through because these are the fundamentals of the ICT trading method. So firstly, we have liquidity, secondly, displacement, market structure shift, inducement, fair value gap, optimal trade entry, and lastly, we have our balanced price range or order blocks. Okay, so firstly, let's look at our first key concept, which is liquidity. So there are two sides of liquidity. We have the buy side as well as the sell side, and then the buy side liquidity as well. So buy side liquidity represents a level on the chart where short sellers will have their stops positioned. Sell side liquidity is just the opposite of that. So it represents a level on the chart where long buyers traders will place their stops. And um, in both of these cases, these levels are often found near or at extremes, as the tops and bottoms of ranges are often viewed as areas where traders are proven wrong and therefore will want to get out of their trades. Okay, another key concept. Um, okay, so continuing with the first key concept on liquidity. This is an example. You can see our buy side liquidity is basically, if you've been with us for previous webinars, we're just basically talking about um a couple of swing high resistance levels in which we can see price has tested that level multiple times. If we look at sell side liquidity, we are looking at basically a swing low support level. You can see in this case, we have we have about four swing lows that line up in the same area. And in our buy side, we have about three that line up in the same area. Okay, Okay, next let's look at displacement. So displacement in short is a very powerful move in price action, resulting in strong selling or buying pressure. Generally speaking, displacement will appear as a single or a group of candles that are all positioned in the same direction. So you can see those that we've highlighted. If you have a long, um, if you're going in for a long buy, for example, you would be looking at three candlesticks that are all in the same direction. Selling pressure would indicate three in the other direction. So the candlesticks that you're looking for typically will have large real bodies and very short wicks, like in the example, suggesting very little disagreement between buyers and sellers. Often the displacement will occur just after a liquidity level has been breached and will often result in the creation of both a fair value gap and a market structure shift. So if you remember last week, we briefly talked about market structure shifts. So we have the uptrend as well as the downtrend, in which price is simply making higher highs and higher lows, and downtrend price is making lower highs and lower lows. So yeah, here's the example that we went through last week on the kind of um, clear market structure that you should look out for. Some more examples here. Okay, next let's look at inducement. So rarely does the price ever move in a straight line. So within a larger trend, there are almost always counter trend moves. So these counter trend moves are the results of lower time frame liquidity hunting. So let's look at the example here. Um, so it's basically in which the price bounces or gets rejected, and then it targets a previous short-term high or low before continuing in the same direction as the longer term trend. So you see in this case, it's definitely a downtrend, and that's why we see this bounce or bounce from here back to in the short term back up here, and then you see it bounce back up here again in the short term. But ultimately, we still see price moving in a downtrend. That's basically what it means. So inducement is specifically the targeting of these short-term highs or lows as areas where stops might be placed. Okay, next let's look at fair value gap. So fair value gaps are created within this displacement and are defined as instances in which there are inefficiencies or imbalances in the market. These imbalances are visualized on the chart by a three-candle sequence containing one large middle candle whose bordering candles, upper and lower wicks do not overlap. So I'll show you an example of this here. Okay, so we have the unfilled gaps over here, and then the gaps that have been filled are over here. You can keep a lookout for the candlesticks that we mentioned earlier as well, in which there is a three candle sequence containing one large middle. Okay, and then the bordering candles are upper and lower wicks don't overlap. Okay, so another key concept is optimal trade entry. So basically represents the best places to get into, and they can be identified by utilizing the Fibonacci between 61.8 and 78.6. And I actually went through the Fibonacci retracements, what to look out for if you're new to Fibonacci. Okay, let me show you guys a website that you can use if you are new to Fibonacci. But in this case, we're basically looking at 61.8 as well as 78.6. But I just want to show you guys, if you're interested, you could go to the forexarmy.com. Okay, and then we have a bunch of trading guides for you to take a look at. Okay, it's taking a while to load. Okay, so you can see here how to draw Fibonacci retracement, and it'll go through really in depth on what to look out for. Okay, and what makes an invalid Fibonacci retracement, what you should look out for, yep, so on and so forth. Okay, so when we say 61.8 and 78.6, we're basically looking at this yellow one as well as the 78.6 level. That's for ICT trading. Okay, I'm not going to go through that. Let's go back to the next or the last key concept, which is balanced price range. So this is the result of an aggressive move up that's immediately followed by an aggressive move down, or an aggressive move down that's immediately followed by an aggressive move up. So what's left after either of these instances is essentially a double fair value gap, which can act as a magnet to the price before a continuation move higher or lower. So balanced price ranges can sometimes signal the beginning of a market structure shift, and the price can often retest and reject from these areas. Okay, now let's move on to what smart money looks like in price action. Okay, so SMC trading involves looking at order blocks, which is a refined version of supply and demand. We'll go through this in a bit. some breaker blocks, mitigation blocks, flip zones, FVG, and liquidity grabs. So order block is simply a replacement for the supply or demand of an asset. Breaker or mitigation blocks is what is traditionally called support and resistance. And our value gaps that we just went through are basically imbalances on the market. So it's basically when demand outpaces supply or vice versa. Okay, now let's get into this week's content. We're going to basically look at liquidity pool manipulation first. Okay, so liquidity pool manipulation, simply put, is where traders place their stop losses and they are strategically targeted by smart money to manipulate prices and profit from buying at higher prices and selling at lower prices. So in this description, refers to areas on a price chart where significant clusters of buy or sell orders are located. So these liquidity pools act as magnets for price. Basically, we call them confluence areas, if you guys remember from the Fibonacci webinars. But basically, it's the same thing. When you identify liquidity pools and understand the significance, traders can anticipate potential price movements and position themselves accordingly. Okay, so now let's look at some trade management some trade management slides. So I'm gonna skip a few, but let's start off with the problem with a fixed take profit and stop loss, and then we will get into stop order blocks. So firstly, we have the problem with our take profit. So in this example, the red area shows a strong resistance area since there have been two swing highs in line with this area. If our trading strategy requires us to have a fixed take profit of 100 pips, we would place the target beyond the strong resistance area. Okay, and let's see how this plays out. So you can see price shot up, and it actually missed our profit target by a few pips before reversing back down. Okay, and the reason for this is because price tends to reverse off of these big areas of resistance and support. Now, in an alternative scenario, if we had placed our take profit before the key resistance level, we would have gotten a profitable trade. So that's why it's important to look at the charts and adjust your take profit and stop loss accordingly. Okay. So here is the proper stop loss and take profit placement that we typically will advise. Okay, so your stop loss, we typically recommend you to place it beyond a major resistance area, and your take profit will be placed before. So in this scenario, we're looking at a downtrend, so we're going in for a sell. Okay, but you can imagine that if we were going in for a buy, it would just flip, but the stop loss would still be beyond, take profit would still be before. Okay, and this is the reason for that. So here we're talking about Fibonacci confluence areas, but it can be for anything as well, as long as there is a significant area in which you have identified price tends to, maybe head back to that area, test that area. It could even be some swing highs that line up together or swing lows that line up together. Okay, so the reason to place your stop loss beyond is because more often than not, price is attracted to such strong areas of confluence. And if your stop loss is right before it instead of beyond it, you will most likely get stopped out. Okay, and you most likely get stopped out right before the market reverses, which is one of the reasons why people wonder why they got stopped out. And then they complain about stop hunting. So next, if we look at take profit, we typically recommend you to place your take profit before a profit, before a key confluence area. The reason for this again is because when price reaches the confluence area, there's a high chance that it won't be able to go beyond it. So instead of reaching your profit target, it will reverse back to your entry or even worse, your stop loss. So that's also one of the reasons why people complain that the market is being manipulated because they miss their take profit by one pip. Okay, here's another example to show why you shouldn't have a fixed stop loss. So here we have a support level with two swing lows that are in line with one another. And price has bounced off this support level, and we are expecting it to continue to rise to the swing high resistance. Okay, so our stop loss will then be placed at or rather it's fixed at the 1894.75 level, which is nicely in line with the double swing low support level. Okay, here's another example. We see price goes down instead, touches the stop loss and bounces off perfectly from the support. Okay, so it bounced off the level and then you can see it's heading for our take profit. So what we should have done instead is to place our take profit, or rather our stop loss, slightly beyond the key level of support or resistance so that we are not stopped out at the support, as price tends to be attracted to key levels of support and bounces off of them. Okay. So this is why it's important to have dynamic stop loss and take profit placement. So dynamic stop loss is a trading strategy used to manage risk in which the stop loss level is adjusted dynamically based on market conditions. So the level of the stop loss is continually moved to a more favorable position as the price of an asset moves in the desired direction. The goal of a dynamic stop loss is to lock in profits while minimizing potential losses. The placement of the stop loss can be determined by various technical analysis indicators or other market conditions such as volatility or market trend. Okay, so let's look at a few examples. Um, So here's a simple example to demonstrate a dynamic stop loss. Basically, you see here that price has bounced off nicely off the support level at 86.721, and we expect it to reverse off the entry at 87.819. And that's in line with the 100% Fibonacci projection level. Okay, we see in this example as well, we have the minus 27.2% Fibonacci expansion. That's in line with a 61.8% Fibonacci projection. Okay, and price is testing the 87.819 level, which is at our entry. Okay, and we're expecting price to drop to our take profit. So instead of putting our stop loss exactly at the Fibonacci confluence area like we did in our previous slide, we want to move it beyond the confluence area instead, and we will show you why in the next slide. Okay, so if we had put our stop loss right at the Fibonacci confluence area, we would have been stopped out. Because you can see the candlestick, there's a tiny little candlestick wick at that just touches the confluence area. Okay, so price is often attracted to such strong areas of support and resistance before reversing off these areas. But you see instead here, price reverse perfectly off the confluence area towards our take profit. Okay, so that's the reason why we place our take profit slightly above. Okay, now let's move on. Let's look at another example. So we expect price to bounce off our entry at 87.625 and the pullback resistance in line with 78.6% Fibonacci retracement. Okay, and here we can see that price has hit our entry and has reversed nicely off of it and is heading towards our take profit. Okay, so now we see that price is dropping from our entry towards our take profit. And our take profit is in line with the 78.6% Fibonacci retracement as well as the swing low over here. Okay, so price has just touched our take profit before reversing off of it. So we managed to catch it just in time. And you can see that if we didn't manage to catch this small wick here, we would have gotten stopped out. Okay, so here's another example. I think I'm gonna skip this. I think, yeah. Okay, let's just skip this and go straight towards our partial profit as well as the stop order blocks that we mentioned for ICT. Okay, so since we are running short on time. Okay, so let's start off with partial profit. So our first example here, you can see price reacted off this strong resistance area and our partial profit at the 0.69871 level. Okay, and it's heading reverse off of it instead of heading towards our take profit. So that's basically what partial profit is. And if we look at idea invalidation, okay, it's basically placed before your stop loss is the level in which you basically admit that you're wrong and you want to get out ASAP. So when this level is reached, your take profit is moved to your entry, giving you a small chance to get out at break even. So our entry here is hoping for price to drop all the way down to our take profit target, but you can see it didn't, it reversed, hit it straight towards our stop loss. Okay, so at this level, in line with the swing high, or the level that we call the idea invalidation level, then we will move our take profit to our entry and get out at break even. Okay, here's another example. So we have our entry at this swing low, and our take profit is at this overlap level. That's in line with a 50% Fibonacci retracement. Okay, so you can see we're expecting price to go towards our take profit, taking note of these levels that are lining up. Okay, so because these levels line up, remember we mentioned a Fibonacci confluence area, so we're placing our stop loss slightly below that, just in case price breaks out of our entry instead of heading towards our take profit. And our idea invalidation will be placed at directly on that level. Okay, you can see that's what happened. So we're going to move our take profit down to our entry and get out at break even. Okay, if we didn't have this idea invalidation, you can see price would have stopped us out. Okay, now let's look at some trailing stop loss types. Basically, we previously went through in the previous slides, dynamic stop loss and take profit. Now we're going to talk about trailing stop loss as a type of stop loss order that you can also use for ICT. Okay, so trailing stop loss is a type of stop loss order that is set at a certain percentage or dollar amount away from the market price. Okay, so the idea behind a trailing stop loss is to lock in profits while giving the trade room to breathe, as the stop loss allows the market price as it moves in favor of the trade. So here's how it works. Let's say you buy a stock. Okay, in this case, we're talking about stock, but you can just imagine it the same way as a currency pair, for example. So let's say you buy a stock at $100 and you set a trading stop loss at $10. So as the price rises to 110, the stop loss will follow now at $100. Now, if the stock price drops to $100, your stop loss will trigger, selling your position and protecting your profits. The trailing stop loss technique can be useful to traders since it allows them to manage risk and lock in profits dynamically as the market moves. Okay, so that's different from the fixed stop loss that we went through earlier. So it's important to note that the trailing stop loss is not a guarantee that you will exit a trade at a desired price. Market conditions such as gaps or rapid price movements can trigger a stop loss order before it reaches the desired level, leading to an unexpected exit from the trade. Therefore, it's important to use trading stop loss in combination with a solid risk management strategy. Okay, so these are the different types of trailing stop loss. Okay, so here's a summary of the different types that we'll be going through today. So first is the moving average indicator, followed by the parabolic star, chandelier and ATR indicator, support and resistance levels, and a combination of these methods. Okay, so sorry about that, Wayne. I will maybe get in contact with IronFX and ask them if it's possible to send the link to today's recording. Otherwise, maybe you can try and email them as well. Um, yeah, I think these will be posted on YouTube as well, but I'm not too sure. So you can check with them as well. Again, so sorry about the technical issues at the start. But yeah, I think if you email them, they'll probably send it over to you. But I'll try and get in contact with them as well. Okay. Yeah. So let's look at our first trailing stop loss example, which is the moving average. So we have a sell entry at um we have the sell entry over here, right? It's highlighted there. And then we can see that price is breaking out of this ascending trend line. So basically, just to recap, what makes a valid trend line is if there are at least 3 touches on the line. Okay, yeah, so you can already see the moving average indicator on the screen. So as time moves, you can see the price movement, price breaking out of the trend line, and it continues downwards. The trailing stop loss is triggered only when it touches or it breaks out of our indicator. So that's where we get out of the trade. Okay, so that gets us out before price continues to move upwards. Okay. Remember, in this situation, we're going in for a sell since price is breaking out of this descending trend line. Ascending trend line. Okay, so in this example as well, we are also looking at a trend line. In this case, we're looking at a ascending as well as a descending trend line. So you can see the red dotted line is our descending trend line, and it has 1, 2, 3 touches. Okay, and our trend line trailing stop loss gets us out when price breaks out of the other trend line. Okay. Next, another example is parabolic SAR. We're using all of these indicators on the same chart to show you guys how you can just play around with the different indicators for your trailing stop loss techniques. Okay, so for parabolic star, we're going in with the same sell entry indicator, which is this ascending trend line. Okay, and then price is moving below our parabolic star, which is an indicator that price is going to continue in the sell in its descending trend in a descending trend. Okay, and then you see here that price reverses and our parabolic star moves below it, which is typically a sign that or that the trend is going to change. And in this case, it did because it broke out of the parabolic star and it headed upwards in an ascending manner instead. Okay. Next, we have chandelier and ATR trailing stop loss. So again, we're doing this on the same chart. Okay, you see price moving below the indicator, so it supports our bearish signal, bearish analysis. And then once price breaks out of it, our chandelier stop loss as well as our ATR stop has been triggered. And then we get out of the trade over here, right before price begins to move in the other direction. Okay. Okay, next, this example is a moving average um indicator. Okay, so you can kind of guess it's the same kind of idea. Price is breaking out of this descending trend line or ascending trend line. So we're going in for a sell towards this take profit level. And once price breaks out of it, then the stop loss is triggered and we get out of it. So this is definitely better instead of using a fixed stop loss like you see up here, because that's way above where our take profit is. So we can get out immediately when the trend changes. Okay, again, another example here. Yeah. Okay, so using breakouts as trailing stop loss. Breakouts are usually high volatility events. So price can spike up and reverse almost as quickly. A stop loss will help you to manage risk and protect your capital. Trading stop loss can help you to protect your profit. So let's take a look at this breakout example. You can see how excuse me, how price is breaking out of the ATR and chandelier indicator. Okay, so we're moving downwards for sell towards this 110.725 level. Breaks out and moves in the opposite direction, and then you can see that's where we get out over here. In this example as well, you can see, this example, at first we see price moving upwards above our indicators, so it's a bullish signal. Excuse me. So it's a bullish signal, and then when price starts to move below the indicators, that's our bearish signal. And it also gives us it's a signal that there is a change in trend. Excuse me. Okay. Yeah, and then after this, you can see that's exactly what happens again. So that's why it's important to label out all of these support and resistance levels, just so that you can see where exactly price is has tested the level before and where you can expect price to reverse or bounce off of those levels again. Okay, and lastly, you can see here we are using moving average. Okay, and we've highlighted the double swing low support levels, as well as this level, which is an overlap level. And then up here, this is just our swing high resistance. So you can see that whenever price moves, whenever price moves above or below the indicator, it can fluctuate quite a bit. That's why we typically won't just depend on one indicator alone. We like to use multiple indicators. Like here, we are using ATR as well as chandelier. Okay, this example as well, so that it kind of, when you use multiple indicators and they give you the same signal, then you can trust your analysis a little bit more. Because like over here, I think only this part is reliable because you see price break below the moving average indicator, giving us a bearish signal. And once price bounces off of the support level, breaks out of the moving average, it's a signal that it's going to move upwards instead. Okay. But yeah. Okay. Okay, that's all I have for you guys today. Thank you guys so much for joining me. And yeah, have a great rest of your week, and I'll see you guys again next week. Bye, everyone.